Hello again. We're going to have a look at an ordinary level leaving cert ratios question, interpretation of accounts, just looking at profitability and liquidity. Because remember, in question 5, profitability and liquidity comes up every year. Here's O'Connell Limited, and there's its abridged profit and loss account. It's got sales of 850,000 that cost them 433, given a gross profit of 417. The expenses including interest are 260, so the net profit is 157. There's the balance sheet then. Fixed assets 840, current assets less current liabilities, giving you a working capital of 157, giving you net assets of 997,000. Financed by an equal amount of capital employed, made up of debentures 300,000 and shareholders' funds 540,000. Part C of the question asks you to calculate the asset test ratio and asks what does it tell us about O'Connell Limited. The asset test ratio, remember, is the ratio of liquid assets to current liabilities, and in these questions it's current assets minus stock is the current liabilities. Our current assets are 250,000. You see them here, and we know that that includes a closing stock figure of 80,000. So 250 less 80, there's our 170,000. And the debts that are falling due, or current liabilities, are 93,000. We see them here in the balance sheet, 93,000. So the ratio of current assets less stock to current liabilities is 170 to 93, or 1.83 is to 1. And what that means then is that O'Connell Limited has €83 in cash and near cash in liquid assets to cover every €1 in debts that are falling due. So it doesn't have a liquidity problem. It can pay its debts as they fall due. And this 1.83 is much higher than the recommended 1:1. So if anything, it's too liquid. Sometimes in this particular question, they ask you if the firm can pay its debts as they fall due, and they ask you to give ratios or to give reasons, plural, for your answer, in which case you'd include the current ratio first. But this particular question has a more realistic approach to it and recognises that really to measure liquidity you're better off just doing the asset test, the liquid asset ratio or the quick asset ratio of current assets minus stock is the current liabilities, and not bothering with the current ratio or the working capital ratio. How profitable the firm is then, that's our return on capital employed. Our formula for return on capital employed, net profit plus interest over capital employed, and in this case we saw that our net profit was 157,000 up here, net profit, but that's before interest. Oops, sorry, excuse me, our net profit was 157,000. We have it up here in our profit and loss account, 157. But before interest, in other words, add interest back to it. And as often is the case, we find the interest by reading it from the balance sheet. They've got €300,000 that they've borrowed from their debenture holders. They owe the banks 300,000, and it costs 6% per annum in interest. So that's 18,000. So add the 18,000 back to the 157,000. And express it then as a percentage of the capital employed or long-term finance, and we get 17.55%. Remember, you compare it with the previous year's figure, and they told us last year's figure was 12%, so the firm's profitability is much higher than last year's 12%, and that's good. And on top of that, in addition to that, it's much higher than the return of between 0 and 1% that you'd get on risk-free investment currently. So that it's a profitable company.